I was watching a live stream, so I was unavailable in terms of streaming. I was meant to stream maybe for the past couple of hours, but I was working on doing some research, market research, and was looking at ICT's live stream of today. I wanted to see how it was inferring or analyzing and interpreting the market. So I was just curious. We're gonna go back to this. I want to ideally finish 16, 17, try get a large chunk of 18 done. So we're gonna have a very short intro and then we'll go straight into the studying. So first things first, start with the website, very calm. You know, I've been working on the study journal now, putting a lot more effort into it. And I can say this much, it's looking good. I like it. We're gonna do some UI updates, clean up some of these buttons and make them look a lot better. And from there on, I will seek to increase. And then we'll probably work on a landing page and spare time. Like, there's no priority of mine. I think it's a clean start. I actually kind of like it. But just like little things, you know. And that would be my goal. We do have this property I did mention, this Asset Homes. You can search on Airbnb in Romford if you want to book it through Airbnb, or you can contact us directly on the website here. Okay, so very short intro. Now, last episode we were going over right. We're gonna reround it quite a bit. We were up to about 30-minute mark, but we're just gonna rewind it so that we can.
What does that mean? This high here was the most energetic one in the morning session. It took us all the way down to what target we were looking for, the daily bullish order block. Because it's Friday, because it hit the daily time frame objective, it's in a discount market. It's really traded lower. End of week, there's going to be a retracement back into the weekly range. What can it aim for? Well, it can aim for the liquidity resting right here, because a lot of people are going to say, well, this is the place where my stop should be at, because I want to hold on to this thing over the weekend. Now, I don't know who has the courage to do that anymore. All the things going on around the world, I personally don't have the courage to hold over the weekend. It's just too many things can go wrong. I'm not sitting in a potential opportunity versus 1,000-point gap against me. We start trading on Sunday. No, thank you. I'll pass on that. But this area here is where you would anticipate on Fridays where liquidity could be a draw, because it's going to likely pull back up into a premium. What does that mean? Here's 8:30. Here's the turning point at the 9:30 rotation. So this high, or we could use this high here, doesn't make a difference, but I'm going to use this one because we're framing the logic behind this day being bearish. So this high down to our target. If you put a Fibonacci on this low to high and find the 50% level, this is above 50%. So that means above here, that's a premium. So the market's going to move from what? A discount to a premium. That's what the market does. That's the algorithm does. It seeks discount to premium, premium to discount. Within that logic, the market is reaching for liquidity in the form of buy stops and sell stops, and or imbalances, or the creation of an imbalance, fair value gaps, or returning back to a fair value gap. Okay, that's all these algorithms do, and they do it on the basis of time, then price. Now, that's a gross oversimplification by me, but by far and large, that's all these things do. It's not your buying and selling pressure, okay? It's not the effects of the DOM, okay? I got a lot of people asking me because they watch me show things in my live account, and they think I trade with the DOM. I don't trade with the DOM, okay? I'm not looking at the DOM trying to read how many orders are resting above or below, because there's spoofing that goes on, and those orders may not be there when the price goes there. So I don't think that the DOM is something that is useful. I'm only throwing it in here because I saw a lot of people in the comments asking about those types of things, and I don't use them. I don't use them in my trading, and I don't think there's anything in terms of advantage in using it. If you believe you're being profitable because you are, don't let my comment change your mind. And I'm not trying to open up a dialogue for debate, because you're never going to convince me. Okay, so you're okay if you're using it, but I'm answering students or viewers, and that's my opinion. Okay, so I'm not trying to begin a debate about it. Okay, so we have a PM session buy side liquidity pool that the market could likely reach up into, and again, the logic is we move from this high down to a target. It's Friday. There's probably going to be position squaring. They're going to want to take the market back higher. So what are they going to reach for as an opposing move? Notice what I'm saying here. This was the target. There's going to be short covering. Who's short covering? The smart money that sold short here, 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 and here. So if they're covering a short, are they bearish still? No. So if they're not bearish, what are they? Bullish. So if they're going to be smart money and buy down here, or if they're going to use this imbalance in here, if it trades down into that, you can see a run higher. If they're going to buy it, what are they going to target? the buy stops up here, and they're going to sell right to those buy stops. They're buying this and selling it to these waiting buyers on their buy stops. Notice these relative equal lows. They take it into the order block right below those relative equal lows because it sells what? It sells the retail crowd that this was support broken. What are they going to want to do? When it trades back up into these relative equal lows, they're going to do what? Sell, right? That creates more liquidity for buying. So this is engineering buy-side liquidity on the basis of sell-side flow. Sellers coming in the marketplace. These sellers, they're going to have counterparty in the form of smart money buying it. They want to sell short because they see relative equal lows breaking. The trend's been down. Everything looks bearish to them because it's been going down all day long. So they think naturally it's going to keep going down. When it's only traded down to where the algorithm says this is what we wanted, and now we're going to reprice higher. We're going to move from a discount to a premium. The premium intraday is going to be this area here, and that's going to be where the market draws to for the afternoon session buy-side liquidity. All right, I was going to do the pause the video type thing here, but this is going to be a long video, so I'm just going to go right into it. All right, so we have a mitigation block here, and I'll teach that in the YouTube channel. But we have market structure breaking. We come back down into the mitigation block, and we also have the imbalance. Here I got there. So we can be a buyer here. And remember, the 45.32 to 45.40 level. Go back up to this chart here. Right in here. So this high, right here to here. Think about those price ranges. We trade up into it here. So buying here and aiming for that liquidity up here, that would be your target from buying to getting out there. Selling to those waiting buy stops. The next one is here. The market trades down in. And I count you to go into your chart. I left this out for your own personal study. But if you look to the left, go over here, you'll see an old high. Okay, old highs are a discount array. If you trade above an old high, that old high becomes a discount array. This is where, not all the time, but this is where old highs being broken becomes support. That's why sometimes the books have it right. That's why sometimes your analysis will be right about specific key highs and lows. But notice they're not always consistent, and that's the problem. So you want to know what makes a old high or an old low real support or resistance when you have the logic I'm framing here, because we know the likelihood of the market's going to draw up into this area here because that's where the buy stops are resting above the marketplace when it hit the order block down here. So what we're saying is the market's going to bounce from here up into this vicinity here. So if the market comes back down in and touches, it could have touched this high here, but there's an old high to the left over here. You'll see it. It trades down and hits that, and it also fills in an imbalance. When you have that, old highs broken will act as support. So here's something for your notes. Over here, you'll see it. It trades down and hits that, and it also fills in an imbalance. When you have that, old highs broken will act as support. So here's something for your notes. Then we have the run up into that area. So it's not a bad little run. Now, once we get up into that shaded pink area, what have we done? We fulfilled buy-side liquidity in this area here. We have a little bit more later on, which obviously you can see it runs through, but here we see it do a run lower. So we break below a swing low. Market structure shifts. Is there any imbalances in here? No, but there is one right there. See that? Here's your fair value gap. Shift in market structure there. Retraces back up into the fair value gap. You can be a seller there. And aim for this low or the order block. Or you can wait for a confirmation entry, which is we turn here after it hits that fair value gap, breaks lower, then we have another breaking the structure of the marketplace on the 1 minute chart. Creates the imbalance here, fair value gap, trades up. Yes, it overshoots it, but we also have two fair value gaps. Remember the rules I gave you? If you have a fair value gap and a small one right above it, anticipate it likely trading up into, but use this as your entry. Go short here and aim for the order block. So if you have to the left over here. You'll see it. It trades down and hits that, and it also fills in an imbalance. When you have that, old highs broken will act as support. So there's something for your notes. Then we have the run up into that area. So it's not a bad little run. Now, once we get up into that shaded pink area, what have we done? We fulfilled buy side liquidity in this area here. We have a little bit more later on. Which obviously you can see it runs through, but here we see it do a run lower. So we break below a swing low, market structure shifts. Is there any imbalances in here? No, but there is one right there. See that? Here's your fair value gap, shift in market structure there, retraces back up into the fair value gap. You could be a seller there, and aim for this low or the order block. Or you can wait for a confirmation entry, which is we turn here after it hits that fair value gap, breaks lower, and then we have another breaking the structure of the marketplace on the 1 minute chart. Creates the imbalance here, fair value gap, trades up. Yes, it overshoots it, but we also have two fair value gaps. Remember the rules I gave you? If you have a fair value gap and a small one right above it, anticipate it likely trading up into, but use this as your entry. Go short here, and aim for the order block. So, if you have an understanding of how we're going to work within the intraday volatility, using liquidity, using the time of day, using the day of week, all these things come together and they make a really beautiful tapestry so you can read price action. Now, I know there's a large number of you that are going to watch this, and it's going to feel and seem like obviously anybody can go back in time and do these types of things. But a lot of my trades, when you see my examples and you see the things I record and show you, they're using logic like this. So it's not contrived, it's not form-fitted, it's not cherry-picked for the purpose of just being something to talk about. This is what you're looking for. And when you do your back testing, I got a lot of questions in the comment section about this as well. You go through your charts, just like I'm doing here, and you annotate them. Now, in all these areas where there's empty space here, or over here, or over here, you're putting in little notations and you're typing them out. And yes, it takes time. Yes, it's tedious. Yes, it takes a great deal of effort and desire. But this stuff rewards that. It rewards it. It's not like fantasy football where, who cares if your team wins? This pays you. This is something you can feed your family with, okay? If you need your expenses to be reduced and you don't want to get another job, or you take a pay cut and you get a job loss or whatever, this skill set can fortify any weak links in your financial chain. Okay, you want to build strength in your ability to make income and build legacy wealth. It's worthwhile for you to spend time learning this, and that means going back through old charts and old moves and literally going in and annotating the moves like this and mapping them out and seeing the logic that's there. Now, do not be afraid that you're going to do it wrong. All of you are going to be doing it wrong in the beginning. This is a skill set in backtesting you're trying to discover. Okay, you're not trying to do things correctly in backtesting. Backtesting is you in a mode of discovery that proves efficacy. If you can't see things repeating, then you got to go back into the core content lessons of this YouTube channel and figure out what it is I'm teaching conceptually. Then once you understand better what it is I'm showing you, then you go back into the old data and look for those very things occurring. Then highlight the things in your chart that makes the most sense to you. Over time doing it, and frankly, you should be doing this at least a minimum of a year. Okay, make it a practice of doing it all the time. Even when you start trading with live funds, your trade journal should always have annotations. You should always have charts saved and just constantly referring to what you witnessed in price and record it like you saw it happening and knew it was going to happen in advance. That's called self-talk. Okay, you're literally tricking your brain into seeing your annotations as something that you foreseen coming. And that way, when you go back and you read your journal and you study on the weekends, or whenever you go through a period of drawdown and you need encouragement, you go back to your charts in your journal and you'll see annotations that you wrote out yourself, and it tricks your brain into believing that you've seen that all along. Now, what happens by doing that over time is you have created creases in your brain where that knowledge and that pseudo experience has been retained, but your brain remembers it as what? A real experience that you endured. but you're recording it with positive reinforcement in your commentary. Never put negative comments in your annotations. Don't say like, oh, I was stupid, I missed this. Oh, I'm so dumb, I fell victim to the shark pattern. Don't do all that kind of stuff. You don't have to worry about swimming with sharks. You don't have to worry about animal patterns. You don't have to worry about any of those types of things. All you're looking for is liquidity, imbalances, time of day. That's it. That's it. That's all this game is all about. Okay. The algorithm is not going to try to follow some retail logic stuff. It's based on where's the money. Where's the money? Who's the most easy prey right now? And where is the majority of the money? And that's where it's going to run for. That's all it's going to do. And if you strip everything you think you know about the markets away and just give me a couple months, stay with me for a couple months here, and I promise you, you will put everything else down and see it like this. Because this is the truth. This is the perfect understanding of what makes these markets book. That means what makes them go up and down, where they turn, why they go where they go, why are they moving when they move, and why are they arriving when they're arriving at that price point. It's all algorithmic. And it has absolutely nothing to do with ratios. It has nothing to do with anything harmonic, nothing supply and demand zone, nothing to do with Elliott wave, nothing to do with Wyckoff, nothing to do with Gann. None of that stuff has anything to do with it. I literally have just explained exactly what these markets do. That's it. There's nothing else that happens. The buying and selling pressure, it's a myth because these markets are going to go higher regardless of how many contracts come in. If they want this thing to go up here, it doesn't require millions of contracts to put it there. It doesn't. How many contracts does it take for this candle to move from that opening price to that closing price? Tell me, how many contracts does it take for that to happen?
No idea.
It only needs two transactions. Two transactions, one here, and when it gaps up here and reprices to that price point and it offers it to a market that price, and someone comes in with a market order, what happens? Boom. It's it. The candle's been created. Two trades. How many contracts? It doesn't make a difference. You only need a transaction. What? Yeah.
It's true.
Folks, listen.
It's actually kind of true.
You can sit down and listen to these videos I'm producing and come in with the preconceived notion that everything I'm saying is nonsense, it's not true, and it's not valid because you don't want it to be. All I'm asking you to do is put everything you think you understand, put it aside for a moment. Just for
I'll be honest. When I first heard about ICT, I quickly put that into the side. I just thought it was overcomplicating it. They're doing too much. Literally, I remember thinking this. I literally remember the thoughts in my mind. I literally remember thinking about ICT, smart money concepts, all this types of thing. I'm thinking people are just bringing in their own nonsense into the marketplace to try and take people's money. Little did I know they were onto something. The problem is going to the wrong source because a lot of people are teaching ICT and they are watering it down, or they are putting their own add of sugar or their own 2 cents alongside the teachings that they've learned. Or they maybe heard it, or they don't just take something small, they don't properly study it. And so they are now spewing nonsense because it's when you take the truth and you add your own truth to the truth gets polluted. It's like a white lie. Like when you take the truth and you add your own source to it, it's not exactly a lie, but it's definitely not truth. And so you can be in very dangerous situations when you don't submit yourself to a certain process, which is why, for example, me, I started off just getting my mind used to liquidity by trading very simplified strategy. And it was based off of like the first couple of episodes of ICT, but also utilized my old model alongside the introduction of actually basing my strategy on liquidity rather than just patterns. And so when I combined the two, I saw improvement, but it wasn't enough. And I realized one of the things is bringing the whole model down. It's either my preconceived knowledge of the market or my pre-learned or my already learned, my knowledge that I had at the time was not good enough, or what I'm utilizing, I just introduced is not good enough. And based on the fact that I went for a bad stint for a couple of months, I decided that it was probably my previous model. Once you learn the market to a certain degree, you then become a person that knows more. See, there's a law where the more you have, the more you'll get. That's why there's a saying: the poor get richer, the rich get richer, the poor get poorer. It's not because the rich are anything special, but when you have something, there's a lot of things that change. Your mindset's changed. The connections you have has changed. The systems that brought you to where you got are able to be multiplied. It's when you're multiplying something, it's so much easier to multiply 5 by 5 than 5 by 0. No matter how many times you multiply 0, it will always be 0. And so with a poor person, they are very close to that 0. And so when they multiply things, they don't even have up to 1, because if I was to multiply 2 times 0.5, the 2 will go and become 1. So you would actually lose money. That's what poverty is staying with that range of 0 and 1. Well, to be fair, it could even be less than 0 if you're a person that's a gambler, right? But it's becoming less than 1. You need to have something, because when you multiply any number by 1, it will stay the same. So there's no growth, right? Which is a bad thing. If it's less than 1, it will reduce. That's why you have things like half, a quarter, right? Then if you are slightly, you're doing well, nothing amazing. Let's say you're 1.1, right? That's who you are as a person. If I could summate your wisdom, your knowledge, your skill sets to a number, and that's give you the number 1.1, but I times that 1.1 by 1,000, you get 1,100. You're actually going up, but you're not going up by much, right? And so when it's in the topic of knowledge, when you have knowledge, you need to keep growing your knowledge so you can become a higher number, so that when multiplication comes knocking on your door, you have something to show the multiplication. If I wanted to multiply if I said to you, I will multiply your wealth by 10 times, for the people that are in debt, I'm multiplying a minus number, so they get further into debt. If somebody doesn't have anything, or they have something very little, let's say they have £1, and I'm multiplying them by 1,000. Well, guess what? You just earn £1,000. Now, £1,000 ain't going to do much in this economy, but guess what? It's £1,000 more than you didn't have. But if imagine someone they just did the bare minimum, they saved, they did the average job, they saved a 10K. Well, now you have 100,000. So my point is that multiplication coming knocking is opportunity, is chance, is business ideas, is plans, is the risk, the business idea you had, right? That's what that multiplication can look like when it knocks on your door, and it will come knocking, looking for what you done, what do you have, what's your actions been like, and how close are you to your goal than you were yesterday? Those are the types of questions multiplication asks, and you will always have to give an answer, because multiplication does not go back to its master void. There will be repercussions. So I say all of this. I know it's very philosophical and very coded how I'm talking. It's all intentional, but my point that I'm deriving this kind of philosophy or this idea from is the fact that once you are in the market, you start off as a babe, as a chick, you don't know much, but you learn. And then as you continue to learn, you think you know something, but you actually don't. But that's the key to knowledge. The more you get, the more you realize you don't have. The more you get, the more you need to get. That's what knowledge should tell you. I know this much, but I don't know enough. So let me go back and get some more knowledge. So with that being said, as a trader, we tend to get stuck at some point where we think we know it all. It's just about finding the correct strategy. The good thing is, once you've mastered psychology, once you've mastered character, all these types of things, and it becomes strategy, that's the problem. Then you don't need to understand the markets. You need to gain understanding, and that's what this model teaches. So the reason I stopped here is because he went on a little bit of a run, but also I needed a little bit of a break. I have been working the whole day despite me only streaming for 20 minutes, so it is a little bit of break. It's like a 5-minute conversation. But anyway, without being distracted, we just simply made... the reason why I didn't make any notes for anything he said recently, mainly is because he's talking more mental. When it's mental, I'm very picky with what I write down. When it's also something I already know, I don't like to clutter my document. I may verbally talk about it, refer to it, or sometimes I do put it back. Like he said that he's mentioned before about 2 fair value gaps, but I still mentioned it because I'd forgotten I'd written that down. So if I forget something, I don't know something, I'll write it down. But if it's something I know quite confidently, I may not write it down. Let's go back into the video, and we might go in a couple more rants because, yeah, I should be streaming as well. Sorry, I'm speaking a lot. It's a lot of information in a short amount of time, but I do want to finish streaming in around about an hour.
For a little while, and go in and do the things I'm telling you to do. I guarantee you will absolutely fall in love with this, because this is consistency. This is consistency that you have always hoped for, but everything else just falls short in delivering it. And you're getting it for free. And I'm loving it while giving it to you. Because I know, and you're all going to see it, when all these little light bulbs come on, and all the people watching these videos, and folks, this channel's growing. It's growing. And this train's going to keep on rolling. Yeah, this community is getting bigger and bigger because it's infectious. Results matter. Proof matters. Excellent. And when students go into this and they see the results, man, it's sweet, isn't it? Isn't it sweet when you see the truth finally just laid out in front of you?
Yep.
There's no trickery here. There's no twisting of your arm, giving your credit card payment. You don't have to blow any kisses to me, okay? I don't need flowers. I just want you to make a real effort and then tell me what your results are. What did you get from it? I promise you. I'm promising you. You will find what you're looking for, but you got to put the work into it. Because you don't put the work into it, it won't matter. Because you'll just think it's too much work. And I'm telling you, it only feels like a lot of work in the beginning. But once you understand what you're looking for, like this setup here, that might be your particular setup. And this up here isn't your setup. This might be your setup here because it's based on that old height. You'll find if you scroll back on your chart, that might be your setup and not this one down here. That's what I'm referring to when I say when you find your unique model. That means a setup that is so similar. Every time you take it, it repeats the same general idea, just in a different chart, on a different day, in a different time frame. That's it. That's all it is. That's your unique model. You're learning how to do it with what I'm teaching you. But where you're looking for it, in what market, in what narrative you're looking for, what makes that setup your particular setup, that's a unique thing for you. And that's the weird beautiful element to trading and the way these markets operate is it allows each and every one of us to have our own unique model. We can all use the things I'm teaching and all find setups within the same trading day and be opposed to every individual trade setup individually. No, we could all be doing something and not agree with any of it. You took a short there, I was long a little while before that, or I went short and you went long somewhere else, and you're ending a trade where I'm getting ready to put on a trade. It's amazing. But how you internalize the market, what setup you're looking for, there's lots of them. And if you break this chart down to a 30-second chart or a 15-second chart, there's even more setups. Everything's fractal. So if you want to do high frequency trading, you can do that with the second chart. You may not be able to pull up second charts because you may not have the, I guess, the subscription level on TradingView, and I don't get any subscription kickbacks. I'm not trying to.
There's one thing I like about the model, which I've seen. I mean, I remember before we engaged, and I did mention this slightly earlier, that prior to starting the studying of this mentorship, I was implementing the ideas of my previous model with the idea of liquidity. I was very new to it. I understood it, but my knowledge of liquidity stopped and ended at the perspective of institutions doing it and they're manipulating price. And they're doing it to target people like me, which is retail traders. That was my understanding of it. Nothing more, nothing less. I never knew what internal liquidity, external liquidity. I didn't know where liquidity was. I just thought it was a spontaneous thing, like spontaneous combustion. I literally see the markets. It would wick me out and go my direction. I'm like, what the heck is this? And that's what my knowledge of liquidity was. Now, with this model, it allows you to extract what you like and choose your, like he was explaining just then, where you want to enter the markets, what type of trades you want to take. What you may be looking for is things like this. After you swept liquidity, I think it was buy side liquidity got swept here. It was that shaded area, and then you have the market to shift. You have the pullback, the fair value gap. It came back up to this fair value gap. The trade, you might want multiple confirmations, take it to a discount area, whatever it may be. But you can extract simplified methodologies of thinking, utilizing the principles that you learn from this mentorship to then create your own personalized entry model specified to your proclivity of trading. A lot of big words, but I think that was the best way I can express myself. Anyway, next.
I'm not buy anything from TradingView. I'm just stating that you can make this however you want. And if you just want to stay on a 15-minute chart and trade the daily range, okay, no reason to do anything less than that. But if you want to get busy and pyramid your positions, that means, like, say you bought one down here, or say you bought 5 down here, and you bought 3 here, and you bought 2 here, and then you rolled it into.
For reference, I'm probably going to be the person that pyramids. I like the idea of compounding quite quickly. I also like the idea of being flexible. I feel like being compounding allows you to be flexible, because even if price reverses, you have multiple positions protecting. It's like a hedge fund where they buy and sell a market, and they are hedging against themselves just in case price doesn't go their way, but they are at least making a profit if it does not go their way. And if it is going their way, then they make more profit, or they're reducing the losses, should I say, if it goes against them by hedging. But I don't like the hedge fund model personally.
Your objective, that's pyramid. Your biggest position, throw on first.
Because the thing about hedge funds, or at least the principle, the way it works in my mind anyway, the thing I'm thinking is that you are buying and selling, right? So you're prone to extremes. It is basically like trading, but you're scared. That's literally the way I see it. Because if you're trading, price goes your direction, you make a little bit of money, but you lose some of your profits because you are hedging against yourself just in case, right? But if you lose a trade, you're just mitigating some of your losses by, the fact that it went against you, but you're also buying against the direction of price. No matter where price goes, you're buying it with it. It's just whether or not you believe it's going up or not. So you're just literally just changing the factor of how much you're making. Now, that's a very simplified understanding of hedge funds. I know it's a lot more intricate than that, and they have models which are built on ridiculous amount of backed up data. So I do get it, but at the same time, I don't like the basic principle. When I don't like the basic principle of a thing, I don't bother go into it extremed or go deep into it, because it's like, if the foundation is rocky to me, I don't want to build my house there.
A smaller position and a smaller position, and then that's how you build up the equity and the velocity in here. I think go that way. Versus buying 1, then buying 2, then buying 4, then buying 8. That is reckless, and I've done that, and I've worked with accounts doing it. So don't do that. But hopefully,
was the same reverse pyramid.
Versus buying 1, then buying 2, then buying 4, then buying 8. That is reckless, and I've done that, and I've worked with accounts doing it. So don't do that. But hopefully, this is at least got your viewers turning about how you can go in and back test a little bit, how you can see multiple trade setups, and how we can work higher time frame PDA arrays, and the PDA array matrix where it's discount to premium and premium to discount, and how we use and incorporate all the different arrays. Where I'm sure someone new watching this, your head's spinning right now. You're like, I have 1,000 questions right now. I need to know this. No, you don't need to know what you're asking for right now. You only feel like you need to know right now. Take the things I'm showing you at the pace I'm showing you, study them, and I promise, a couple months from now, you're gonna know a whole lot more than you know right now. And you'll be able to go in and see things in price action that you don't even identify right now, even in hindsight. You just gotta give yourself the time and give yourself the real effort to learn this. I've stripped it down, I made it as streamlined as I possibly could, and I promise you will get this. And so I'll talk to you next time. Be safe. This lesson is going to be on Forex and how we can apply this model to the
Yes, that's my model I trade. Finally, I'm not in the futures right now, so
FX market. Now, if you are a long-time student of mine, a lot of things I'm going to talk about here are going to be very familiar to you. I promise you, the things that the newer students that just found this channel are going to feel like they're stuck on. The majority of it is in the free lessons in this YouTube channel. Okay, so I'm going to count you go through those videos and you'll get your answers there. Okay, all right. So if we're looking at the euro dollar, and I'll let you know that's what this is. This is the daily chart for euro. I want you to take a look at how price moved above these relative equal highs right here. Now, once it did that, this took the buy side or buy stops out of the marketplace here. And then started going lower. What would it likely be reaching for next? Well, it took buy side out here. What do you think is below here?
wait, why is buy stops? Oh no, I've been saying. Wait, I made a mistake. Here.
What would it likely be reaching for next? Well, it took buy side out, reaching marketplace here. And then started going lower. What would it likely be reaching for next? Well, it took
Sell
buy side
side.
out here. What do you think is below
Bam,
here?
bam. Sell side.
Sell stops or sell side liquidity. Now, just to the left, notice these two little devils here, relative equal lows. And with this one and this one, we have two areas of sell side liquidity.
Yep.
Notice this candle here, which happens to be Monday's trading or yesterday's trading. Now, this low did not take out that low yet. Notice that? So we have unfinished business below here and potentially below here. So this is a daily chart. Even though we've come from this high and had 3 consecutive down close candles, what is the bias? The very next candle,
Bearish.
what's the bias going to be? Bearish. We're anticipating bearishness going in. So let's take that and flesh that out a little bit more. So here is your chart that we annotated. And you have this level on your chart while you're learning. It's important to have these types of things on your chart. Over time, all you use a pad and something to write with, and you'll write down the levels. Majority of the time, the only time I'm showing a level on my chart is for teaching purposes. I like to keep my chart clean, and that way I'm not forcing that bias. If I see something that would allow me to like negate the whole premise that I went into the market with and either reverse or move to the sideline, I want that clarity. Now I say that, and some of you purists in here, just simply want to do everything I say, hang on every single one of my words. Don't avoid. So let's take that and flesh that out a little bit more. So here is your chart that we annotated. And you have this level on your chart while you're learning. It's in 2 areas of sell side liquidity. Notice this candle here, which happens to be Monday's trading or yesterday's trading. Now this low did not take out that low yet. Notice that? So we have unfinished business below here and potentially below here. So if this is a daily chart, even though we've come from this high and had 3 consecutive down close candles, what is the bias? The very next candle, what's the bias going to be? Bearish. We're anticipating bearishness going in. So let's take that and flesh that out a little bit more. So here is your chart that we annotated. And you have this level on your chart while you're learning. It's important to have these types of things on your chart. Over time, all you use a pad and something to write with, and you'll write down the levels. Majority of the time, the only time I'm showing a level on my chart is for teaching purposes. I like to keep my chart clean, and that way I'm not forcing that bias. If I see something that would allow me to like negate the whole premise that I went into the market with and either reverse or move to the sideline, I want that clarity. Now I say that, and some of you purists in here, just simply want to do everything I say, hang on every single one of my words. Don't avoid or don't try to do it without having annotations, like having levels drawn on your chart, because you need to train yourself to see it. And what I mean by that? Well, having these relative equal highs highlighted, your buy stops would be resting above here, and the market will go just above that a little bit, and then once those buy stops are taken, for anyone that's short, they're getting knocked down in a loss, and that flood of orders to be buying at the market is counterparty to individuals that want to sell short. So smart money is selling short up here, with the expectation it's going to go below this low here, and potentially below that low down here. So today's trading, we had the open, it rallies up a little bit, then careens through the short term low here, and below the relative equal lows here. Not by much, we'll see it, but it's still there. Now, what level on the downside after this day close, if we're looking for lower prices, what could we expect to draw to? Obviously below here and below here, but what price level? 109, big figure. So big figure numbers, okay, or the zero levels, they're very influential because there's lots of liquidity that is used around those levels. A lot of commerce, a lot of business transactions that come in just for the sake of simplicity, 0 level, the 20 levels, the 50 levels, and the 80 levels. So I love them institution price levels. I teach that in the free videos in this YouTube channel too. All right, so we're gonna drop down to it.
He's going so fast, I cannot multitask. Obviously, I sped up quite a lot, so it is that. But I can keep up him a quicker pace and then also annotate my own document. But I can't right now when it's at 2.3. So I'm going to take a little pause and then we'll continue. So what I want to make note of is I want to show the before and after. At first, I was just going to show the after, but sometimes it's good to revisit some screenshots. So the before will be us explaining this market without any markup. So we're going to explain that these equal highs over here, which is buy side liquidity, has been taken out. Then price is now targeting sell side liquidity, which is these sell stops, which is this low right here, this low right here, and this is also equal lows, and then potentially down here. So once we've taken this out, we are targeting these areas. Our main question would be, okay, we've taken our buy side liquidity, fine. Why are we not targeting more buy side liquidity? Now, obviously, it's about what's more likely than not. And then we have just been taking out this. The buy side liquidity doesn't look like there's anything close to price, but you also have that aspect of this one being stronger and closer with these equal lows as well being a tantalizing kind of target for the institutions. So market side has buy side liquidity based, I'm trying to say equalize because of And then it's targeting sell side liquidity below LT lows and relative equal lows. There we go. So I'm gonna have it like this. I can move this up here.
0, level, the 20 levels, the 50 levels, and the 80 levels. So I dubbed 0,
Okay.
level, the 20 levels, the 50 levels, and the 80 levels. So I dubbed them institutional.
I020. That's such a weird, like. I know it's like there's uniformity, so I think I might make that note a new tab. Just take any. Could just be a small note. So on Forex, especially, there is a lot at these ecological levels, being that they $100, 20, 80. I move it.
Price levels. I teach that in the free videos in this YouTube channel too. All right, so we're going to drop down to an hour chart. But before we get into that, I'm going to revisit the swing trading idea that I taught. Highest up close or opening in this retracement up, and the lowest open or close. Swing trading idea that I taught. All right, chart. Before we get into that, I'm going to revisit the swing trading idea that I taught. Highest up close or opening in this retracement up, and the lowest open or close is here. So I left the highlighted candles so you can match it up on yours. And then we have this old low. So below this old low, if it goes below that, how many pips can it go below that? Well, we have the big figure 109, right? Remember the previous chart here? Watch. Over here, that's essentially the 1.09 big figure. So do we have any levels in here on the fib that correspond to that? Well, we have 1.0919, that's possible. Then we have 1.09101, that's another level that's possible. And we have 1.09011, essentially almost the big figure, right? So we have a standard deviation from this swing to here. If this is broken, these are only true if this low is broken, okay? So this is a fulcrum point, and this is a fulcrum point. So how do we know which level we're going to aim for? Well, we have those relative equal lows at the 109 big figure level. And then we have our fib calling for these levels down here. And the lowest one without going through 1.09 is this one here. All right, on the
Maybe. We don't actually need it this long. 0820. One step cycle should be fine. To me, it looks good zoomed in. Don't really need this side here, so.
Is this level we're going to aim for? Well, we have those relative equal lows at the 109 big figure level. And then we have our fib calling for these levels down here. And the lowest one without going through 1.09 is this one here. All right, on the hourly chart with our buy side liquidity.
This is 1 hour.
Pull up, calling for these levels.
It's actually packed, even though it's only 27 minutes. Okay, this is the hour. We have a fifth from a daily range, which. Wait, that 109 level, where is that from again? So I don't have. Is this relative equal lows? Okay. So and this is only true if price is low is in the red circle. That being said, let's create the red circle.
Then we have 1.09101. That's another level that's possible. And we have 1.09011. Essentially almost the big figure, right? So we have a standard deviation from this swing to here. If this is broken, these are only true if this low is broken. Okay. So this is a fulcrum point, and this is a fulcrum point. So how do we know which level we're going to aim for? Well, we have those relative equal lows at the 109 big figure level. And then we have our fib calling for these levels down here. And the lowest one without going through 1.09 is this one here. All right. On the hourly chart with our buy side liquidity pool level here, the market trades up into that area, absorbing all of that liquidity, then breaking down, takes a short-term low here, and here, and here, retraces up in, breaks lower, then we go into.
There you go. It's the same thing, right? wait, this is 4th of April. It's tough to see where this is.
Our buy side liquidity pool level here. The market trades up into that area, absorbing all of that liquidity, then breaking down, takes a short-term low here, and here, and here, retraces up in, breaks lower. Then we go into today.
I'd like to see the lower time frames of this.
Today's trading, the 5th. Prior to the day starting, we know that it's likely to draw below here and then down to that 109 big figure. Have a lot of convergence around that 109 big figure. At the beginning of the day at midnight, New York local time, that's going to be right in here. If we see the market rally up, which is what we want to see, we want to see a protraction in the marketplace where it starts to go against the expected direction of the move intraday. So if we're bearish and we're looking for that 109 level to be traded to and attack the liquidity below here, preferably we want to see it rally first. That's the Judas swing. Okay, that market protraction is what we're looking for manipulation part of my concept power 3, which is accumulation, manipulation, distribution. Okay, so once the day begins at midnight, we're anticipating a move up. What's it going to be trading up into? This imbalance in here. Okay, so once it does that, it kind of like forms the daily high, and then the rest of the day you're going to be looking for distribution.
I mean, this is standard stuff over here. I don't think we'll really make a note of that. You know, you have your rally up. This is liquidity. You take out liquidity in this box here. You can see this red line is marking the buy side liquidity. We take it out. And then in there we have short-term lows here, 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 and here. No, here, here, and here. Then we have price that breaks this low, breaks that low, eventually breaks this low, but it breaks these lows. 1, 2, with this one move here. With that displacement range, you look for fair value gaps in between it. You see fair value gap here. We trade up into this fair value gap. We put a stop loss above the first candle contributing to the fair value gap, which would be this one. So this will be over here targeting these lows down here. So that will be your entry number 1. Over here, then you see at midnight open, which is talking about here, rally upwards, which we want to see, especially when we are bearish bias. Then we have this displacement here, which is what it's actually trading into, which is where we accumulate ourselves to then push the price down to that 109 level.
Throughout the day, looking for lower prices. So inside that little shaded area, we're going to use that going forward. So let's drop down to
I might take it as reference. No.
lower time frame. 50-minute time frame. Here is that imbalance. It doesn't look that clean on the 50-minute time frame, but the hourly is what we're framing it on. Okay. So market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame. Chart. Opening price is here. Extended out throughout the day. That is your midnight New York candle opening price. Preferably, if we're selling short, we want to see price trade above this opening price. This is where smart money is accumulating short positions. See that? So the algorithm goes higher, once more higher, and then again right here, and then begins its descent into the daily range low. Now what's occurring here, this is not buying and selling pressure. The algorithm is offering constantly price above this opening price. Now every single time it rallies up, just because it does that, it doesn't necessarily mean that's a time for you to get in. But when you couple that with time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there, and price runs up during the New York open kill zone. Okay, so I dubbed the specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning.
Let me just give context. So we're seeing the power 3 occur. On the hourly, we drew the fair value gap, yellow box, that signified the area that price would rally to in form of the Judas swing. All right, so that yellow box is the fair value gap. More context, well, this is the midnight open. We drew it across horizontally. Price is accumulating around this area. All right.
This is runs up during the time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there and price runs up during the New York open kill zone. Okay, so I dubbed the specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex. Okay, these times are specific to FX pairs. If you're going to trade an index, don't worry about that. You can work with the 8:30 to 11 o'clock New York local time. But for Forex, the algorithm's going to operate on these specific elements of time. So if we're looking at this imbalance here, the market runs up and it overshoots the imbalance a little bit. But what's it really go to? The last up close candle, which is a bearish order block. How do we know it's a bearish order block? Because we have the imbalance here and it's trading back up into after a nice move lower. So it's displacement, fair value gap, last up close candle, touches it, there's a bearish order block.
So I wasn't listening to anything that was said just then. I was just thinking about, literally said something, because this is only relevant to Forex. I said, wait. What's only relevant to features that I've maybe taken down as a note? So it's the same chart, but I just like the order block he drew. So we start with time.
Okay, so I dubbed the specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex. Okay, these times are specific to FX pairs. If you're going to trade an index, don't worry about that. You can work with the 8:30 to 11 o'clock New York local time. But for Forex, the algorithm's going to operate on these specific elements of time. So if we're looking at this imbalance here, the market runs up and it overshoots the imbalance a little bit. But what's it really go to? The last up close candle, which is a bearish order block. How do we know it's a bearish order block? Because we have the imbalance here and it's trading back up into after a nice move lower. So it's displacement, fair value gap, last up close candle, touches it, there's a bearish order block. Dropping down into a 5-minute chart, everything being as it was on the 15. That's that order block here, just being shown on a 5-minute chart. But I'm adding now the annotation of the New York open kill zone. 7 o'clock in the morning begins here at the end of that line segment, and 10 o'clock is here. So everything underneath this end of the trend line here and below this part of it, this all is during the New York open kill zone. So you're hunting your setup for Forex pairs within that little block of time. So during this time, you're hunting your setup. What price are you looking for? Preferably at or just above the opening price at midnight. Now, if you are a New York session trader, you want to refer to the opening price at midnight, but then you want to recalibrate at 8:30, and we'll look at that in a moment. But for now, just notice, looking at this particular day on the economic calendar, we had a high impact news driver at 10 o'clock in the morning with the ISM services PMI number. Now, before you want to start sending me emails or start sending me essay questions in the comment section of this video about what does the ISM PMI number do, I don't care what these numbers are really discussing. I don't care. I don't care about the raw data. I don't care what the expectation is. I don't care. Okay. What I'm expecting is the volatility in the marketplace at or around these specific times, because the algorithm is going to use that injection of volatility to facilitate trades. Now, is it trying to give you good trades? No. It's trying to move and rebook and reprice to levels to allow those in the know to participate. It's a rigged game.
Okay, so I've been reading some of these comments, and I agree with this. Order block being this one kind of win it before we mentioned it's these here. Now, one person saying it because within a 1 hour fair value gap, I believe you're saying. So let me go back to the 1 hour. I think I took a screenshot of it actually.
Going forward. So let's drop down.
Or this one. Okay, I get it. I get it.
On the lower time frame. 50-minute time frame. Here is that imbalance. It doesn't look that clean on the 50-minute time frame, but the hourly is what we're framing it on. Okay. So the market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame chart. Opening price is here, extended out throughout the day. That is your midnight.
I'm gonna take a snapshot of this though. It does help.
Manipulation, distribution, anticipating. Okay. And then that going forward. So let's drop down to lower time frame. 50-minute time frame. Here is that imbalance. It doesn't look that clean on the 50-minute time frame, but the hourly is what we're framing it on. Okay. So the market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame. That's a time for you to get in. But when you couple that with time of day and price, it comes with time. This is not buying and selling pressure. The algorithm is offering constantly price above this opening price. Now, every single time it rallies up, just because it does that doesn't necessarily mean that's a time for you to get in. But when you couple that with time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there, and price runs up during the New York open kill zone. Okay, so I dubbed this specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex. Okay, these times are specific to FX pairs. If you're going to trade an index, don't worry about that. You can work with the 8:30 to 11 o'clock New York local time. But for order block here, just being shown on a 5-minute chart. But I'm adding now the annotation of the New York open kill zone. 7 o'clock in the morning begins here at the end of that line segment, and 10 o'clock is here. So everything underneath this end of the trend line here and below this part of it, this all is during the New York open kill zone. So you're hunting your setup for Forex pairs within that little block of time. So during this time, you're hunting your setup. What price are you looking for? Preferably at or just above the opening price at midnight. Now, if you are a New York session trader, you want to refer to the opening price at midnight, but then you want to recalibrate at 8:30, and we'll look at that in a moment. But for now, just notice, looking at this particular day on the economic calendar, we had a high impact news driver at 10 o'clock in the morning with the ISM services PMI number. Now, before you want to start sending me emails or start sending me essay questions in the comment section of this video about what does the ISM PMI number do, what's it, I don't care what these numbers are really discussing. I don't care. I don't care about the raw data. I don't care what the expectation is. I don't care. Okay. What I'm expecting is the volatility in the marketplace at or around these specific times, because the algorithm is going to use that injection of volatility to facilitate trades. Now, is it trying to give you good trades? No. It's trying to move and rebook and reprice to levels to allow those in the know to participate. It's a rigged game. You're not supposed to be in it. Not consistently profitable, let's say it that way. But for those that are in the know, they're looking for these types of signatures and price action. So they know what they're looking for in terms of when they're going to operate. So as a technician, they're looking for a specific element of time, which is encapsulated with this segment right here, 7 o'clock to 10 o'clock. So that little bracket of time right there on a 5-minute chart, you're hunting your setup. What is the thresholds that make it high probability? Well, if you're going short or looking to go short, you want to be above the midnight opening price. That's here, extended down time. But now once we hit this order block here, that was during the early stages of the New York Open, right around the 7 o'clock hour. The market drops and then retraces back into that news driver here at 10. So what's happening here is look closely with this swing low. It went below this low here, and then it rallied back up once more above the opening price at midnight. Does it take out this high? No. Why doesn't it take out this high? Because it has an imbalance here. That imbalance tells you this is an intermediate term high. If we're bearish, it shouldn't take this high out. Now, again, I mentioned this in a recent video. I think, if I'm not mistaken, it was episode 12. I'm going by memory.
Why is this not the intermediate term high? He's saying it's this, but why is it not this? Because it's not a definition. Okay. So yeah, it's when you form when we rebalance a fair value gap. This is intermediate term high because we balance this fair value gap. We go back to the video. Oh, you can do that full screen. I didn't even know. Full screen, it will just override the split tab. But the it says if I click out, it will come out. But yeah, it's fairly up from here to here. We rebalance it. This should be the intermediate term high. I think I saw comments speaking about that as well.
That imbalance tells you this is an intermediate term high. If we're bearish, it shouldn't take this high out. Now, again, I mentioned this in a recent video. I think, if I'm not mistaken, it was episode 12. I'm going by memory, so please don't roast me in the comment section if that's the wrong one. But it's basically when I'm talking about intermediate term, short term, and long term highs and lows, or swing highs and lows. An imbalance or fair value gap associated with a swing high or swing low. In this case, this is intermediate term high. Not because it simply has an imbalance, but because the narrative is we're expecting lower prices, and it went above the opening price at midnight. And the imbalance there, when it retraces back up into this fake run ahead of the news driver at 10 o'clock, the news, if you will, this movement here is only running right back up into the bearish order block. Last up close candle, the body. I don't like to use these long tails and wicks. I'll refer to them, but I like to prefer to annotate if I'm going to show it in my examples, or look to price returning back to the body of the candle right there. So this return into that order block sets the stage for another move lower. We get a swing high, lower high to the right of this candle, and a lower high to the left of it here. So we have 3 candles making a swing high. So we start looking for displacement and movement lower. But looking closer, after we had that shift in market structure here on a 5-minute chart, it retraces back up, fair value gap, bearish order block, and news. This is the wild card. Okay, when you have high impact news drivers, this is going to many times scare you out of the trade or stop you out north. If you went short back here and you start trailing your stop loss, this is what that's designed to do, take you out. So if you're short back here or here or here, how are you protecting the trade? You're putting a buy stop above recent swing highs. So they're jamming it up against that, back above the opening price, because your buy stop's going to flood the market with buyers willing to pay a higher price than it was here before it runs higher. And you're going to buy, or those individuals that have their stops, they're going to buy the counterparty side of the smart money that wants to sell short. Because every buyer has to have a seller, every seller has to have a buyer. So that's what's occurring here. But inside the shaded area, I'm going to show you how this model is applicable here in FX. So here's the 4-minute chart. We were just looking at 5, so we can start stripping down this price leg here, and we're looking for any fair value gap. Do you see it? Pause the video, look for it.
What did he say?
And we're looking for any fair value gap.
Within this range.
Do you see it?
Into here, it's very tiny.
Pause the video, look for it. All right, I'm about to show you. This candle's low, this candle's high, there's your fair value gap. Isn't it interesting how it just goes right up in there, closes that in, then and only then, the market starts to aggressively run below the short-term low here, and reaching into our objective down here at that 109 big figure. Now, it doesn't quite get to 1.09 even, but it does get to our Fibonacci extension for the standard deviation. It does get down to the old relative equal lows on the daily chart, which is what that blue line is. Look at the bodies respecting that level. Not much movement below it. Now, for all of you raw dogs out there, okay, this is too much, Michael. You're overcomplicating it. You're confusing me, Michael. You're talking about the midnight candle for the opening price, and now you're talking about the 8:30. Which one do I use? Why do I use it? This, that, other thing. All right. If you're trading FX, you're going to be using the 8:30 in the morning for New York session trades, but refer to the New York open at midnight as well. If the opening price is lower at the 8:30 than that of the opening price at midnight, use the lower one. The reason why is you want to set the minimum threshold for a Judah swing or market retraction to the upside when you're bearish. And obviously, everything that I just said would be reversed if you're bullish. You'd be looking for a move below the opening at 8:30 to go long after it moves below it. But we're focusing primarily on the shorting opportunity here in hindsight, so that way you can get a better feel for how to use this model with FX. So there's a subtle little group of nuances that you have to be aware of when you're looking at FX, but it's not terribly, harsh. It's pretty easy to work with. So we have the market trading above the opening price here. Market retraction, Judah swing, it rallies up, and then breaks down in here.
Okay, we'll probably end on the episode. The reason why this one's taking a little bit longer than normal is because it's detailed and it's finally a forex oriented kind of study session. So we'll spend a little bit longer than I would have thought. Plus, it's like you said, nuances. So yeah, we are paying deeper attention. So what I liked is we got access to information on this what do you even call it, like this market.
Now, Judah swing, at 8:30 to go long. You'd be looking for the opening price at midnight. Use the lower one. Reason why, but you're going to be using the 8:30 in the morning for New York session trades. But reframe candle, you're overcomplicating it. You're confusing me, Michael. You're talking about the midnight candle for the opening price, and now you're talking about the 8:30. Which one do I use? Why do I use it? This, that, other thing. All right. If you're trading FX, you're going to be using the 8:30 in the morning for New York session trades. But refer to the New York open at midnight as well. If the opening price is lower at the 8:30 than that of the opening price at midnight, use the lower one. Reason why is you want to set the minimum threshold for a Judas swing or market retraction to the upside when you're bearish. And everything that I just said would be reversed if you're bullish. You'd be looking for a move below the opening at 8:30 to go long after it moves below it. But we're focusing primarily on the shorting opportunity here in hindsight, so that way you can get a better feel for how to use this model with FX. So there's a subtle little group of nuances that you have to be aware of when you're looking at FX, but it's not terribly, harsh. Price is lower at the 8:30 than that of the opening price at midnight. Use the lower one. Reason why is you want to set the minimum threshold for a Judas swing or market retraction to the upside when you're bearish. And everything that I just said would be reversed if you're bullish. You'd be looking for a move below the opening at 8:30 to go long after it moves below it. But we're focusing primarily on the shorting opportunity here in hindsight, so that way you can get a better feel for how to use this model with FX. So there's a subtle little group of nuances that you have to be aware of when you're looking at FX, but it's not terribly, harsh. It's pretty easy to work with. So we have the market trading above the opening price here. Market retraction, Judas swing, it rallies up, and then breaks down in here. Now, this run here above the opening price, does it have a fair value gap? Here's the 4-minute chart. Opening price now doesn't look the same because we're looking at a 4-minute chart. So it was anchored on a 5-minute chart. It rallies up, it break lower, fair value gap right there, trades up into it, hammers it beautifully, and the displacement trades lower down into that 109. What was it, 1.0901 something or other? I can't remember off the top of my head, but it hit it. And I think the low of the day was 1.0901. So not bad. I mean, it's pretty close to perfect, right? But by itself, you don't want to try to aim for just that level because that's the best exit strategy. You don't want to do that. You want to fluff up your exits with a couple pips. And I like to teach my students 3 to 5 pips. And if you're thinking a target is going to be, like, for instance, we'll say 1.0900 level. Okay, if that's what you think it's going to trade to, put your limit order to cover your shorts if you're short at 1.0905. Okay, you're not going to get the best exit that way, but you have a spread that you have to incorporate when you're working with Forex and FX pairs. Sometimes, and I've had a lot of this happen over the years as a FX trader, where my limit order was a little too overzealous. I was trying to be a little too perfect, and I've had many amazing exits elude me because of my overzealous targeting. So be a little bit more forgiving when you're trading, especially Forex. You got to incorporate the spread. And I know some of you have brokers where it's like, oh, I have a really tight spread. Let me tell you something. Every broker has the ability to open that spread up on you. You're seeing the best case scenario when that ticker is showing, but trust me, when it's advantageous for them, they'll work it in their behalf, not yours. So make it easier for yourself. Just fluff up your exits with 5 pips. Okay, and if you're really new, just use 10 pips. Okay, and if you're struggling with the idea that, oh, I don't want to do that, I'll give up 10 pips. Well, let me show you this. This would be your entry candle, trading right back to this old high here. So 1 pip at or thereabouts. Once it hits that candle with this run here, that right there would be your entry candle. Your stop would be right above this candle's high. Now, if you're scared or whatever, you can use this swing high, and that's fine. Now, in terms of math, your entry price would be 1.09653, and your stop would be 1.09728 hypothetically. That's not a lot of pips. I would generally round that to 10. Even though it's not technically 10 pips here, I would round it to 10 and just be done with it. And looking at that model here, and you're aiming for that essentially 1.09 big figure, fluffing it up a little bit so our exit price would be a little bit higher than that. You guys see these things all the time, and I just feel like using it, just because I want to be cool. The risk is here, entry to stop, and the distribution to your target down here. Risk to reward ratio better than 8 to 1, and use a hypothetical $100,000 demo account. You're doing one of those funded account challenges or whatever. In this trade here, this gives you basically what you're looking for in one trade. So I don't know if this scratches the itch for you, but the stuff works in Forex. It works in index trading. So it's a matter of adjusting to what it is you're trying to trade. And then there's a little bit of rule following that you have to know when it comes to index trading and FX. FX, predominantly, you're working with 7 o'clock in the morning to 10 o'clock in the morning. That's your New York open kill zone. Okay. Index trading, I'm focusing on 8:30 to 11, and I can take a trade all the way up to 10:40, 10:45 and still be okay. I'm not interested in taking new trades generally after 10 o'clock in the morning in the FX pair, unless there is a news driver like we had this morning with the ISIN number, the PMI number I mentioned earlier in the video. So that was allowing me to be a little bit more forgiving with expectations for price. You may not want to trade high impact news drivers, and that's understandable if you don't know what you're doing, but don't be afraid of them. Now, with the economic counter having a high impact news driver at 10 o'clock, that extends the New York session kill zone into the 11:30 time window because the volatility that it will bring in. Now, I didn't take this trade. I haven't taken any FX pair trades at all, not for 2022 at least. But if you're looking at a model that works in index futures, you're looking at that 8:30 to 11 o'clock window. And if you're trying to apply this model to FX, it's 7 o'clock in the morning to 10 o'clock in the morning. Now, the high impact news drivers that come out after 10 o'clock, like for instance, if you're a Canadian dollar trader and the crude oil inventory number comes out, usually like 10:30 in the morning, you have to make allowances for that and just expect there to be a likely move on that oil number at 10:30. So just something to throw out there. I know a lot of you have been barking, wanting to see something FX related, because predominantly I've been doing that since 2010, but I humbly submit this for your inquiry, and that way you can study this and listen to it a few times, ask a couple things in there that may have went over your head. It's not terribly, demanding in terms of note taking, but there's some things in here that are noteworthy for you to have in your study journal. And for the most part, it looks like it works pretty good in this pair too, or in this asset class. So until I talk to you again on Thursday, be safe.
Right. It is currently 4:54. Leaving in an hour and 20 minutes, but I need to cut my hair, wash it, shower, eat, clean, get ready, leave in an hour, 20 minutes. Or I could spend 30 minutes and have only 30 minutes or 50 minutes to get ready. Make chips that will be quick, eat in 30 minutes. Okay, I'm going to end stream here. And oof, these are the next big 2 episodes. To do 13 episodes in 6 days is our next 13. Nope, it's 23 in 6 days. It's like 4 a day. Yo, we have a lot to do, eh? Yeesh. Anyway, it's been your boy CJ. We finished episode 18 at least. So we will, 17 at least. We did 16 and 17. Same thing. I'll see how I'm feeling when I get back. I've been working the whole day. What's this stream been? It's been an hour stream. I then have to travel, go shops, do this, that, the third. It's not going to be easy, but we'll see. Shout out to everybody that's tuned in and watched this back. Appreciate all of you guys. Social media, everything is in the description. It's relevant. And my Instagram, my TikTok, my Telegram, oh yeah, I need to fix that. And then my website. But yeah, it's been your boy CJ. I'll see you guys later today or tomorrow, most likely tomorrow. But we'll see.